United States just printed a 40-year high inflation rate at 9.1%. And now economists are expecting the Fed in the US to come out with a full percentage rate hike in order to tame this huge inflation beast. So in this video, let's dig into where is the biggest price increase, how does it impact the stock market, how does it impact us, and what am I personally doing? I am your host, David Kwan. Let's talk about it. By now, you would have heard the 9.1 really hot inflation print come out of the US. And usually when Bureau of Labor Statistics release these results, we get two numbers. We get the headline inflation number, which is all items, and then we get a core inflation number, which is all items taking away the food and energy, which is like the most important things in our lives. But you can see that for all items less food and energy is starting to decelerate when it comes to the price increases, but I don't understand why you'll ever look at all items less food and energy. If we were to dig into why the headline inflation number is so hot, I think I've highlighted some of the major contributing factors. So you have heating oil and natural gas, which essentially helps us warm us up like in colder climates, is plus almost 70% compared to last year. Gasoline, Brent crude, and WTI crude is up approximately 30% compared to the previous year. And the reason why I have both crude highlighted is mostly because these are inputs to make gasoline and petrochemicals. And if these go up, very likely that gasoline and other petrochemical products will rise in prices. And then it'll show up in food prices because you have to transport the food across different continents or different places to be processed. And off the back of that point, the food index have increased by 1%, while shelter costs, which makes up for about a third of the CPI, rose 0.6%. And generally, shelter and rent are slow to catch on fire. And you can see that it's starting to come out. So I'm anticipating that even if energy prices go down over the next couple months, it might be made up by the food and shelter costs, essentially sustaining at a very high CPI print. And another thing to remember is that when push comes to shove, consumers will always prioritize the essentials, food and shelter. So the discretionary items that are good to have, eating out, those kind of things will likely be deprioritized. Naturally, given how hot this inflation print is, the rumor mill is that the Fed they were planning to raise rates by 0.75%, but now there is speculation that they might raise a full percentage point later this month to try and at least tame the inflation beast up front. It might be too late, but still taking action is probably better than not taking action at this point. And what I am personally expecting was the market to take a bit more of a beating given how hot this inflation print is. And I was actually quite surprised that S&P 500 have treated this event almost like a positive event. It didn't really correct further, but it have grew in prices over the last couple of days. Yes, of course, markets are forward-looking, so there's a high chance that this event was priced in previous corrections. But I was honestly just expecting the market to correct a little bit more to reflect how hot inflation currently is. But it's worth asking this question: will companies in the upcoming earnings season, both Australian and US, how would they do compared to the previous year? My take is that 2021 performance and 2020 performance are outlier performance. So if they don't belong part of the, consumer essentials, and when consumers need to tighten up their belt, then it's very likely that their earnings per share won't match the previous year. So if we look at the current S&P 500 PE ratio, it's around 20 at the moment. The share price for S&P 500 have corrected pretty substantially over the last couple of months. We all have felt that. And that is to reflect the new reality. And if the upcoming earnings per share for these companies, it won't impact everyone, but for some of these companies, if they don't match, then it's very likely that the share price will need to come back down to reflect the historical average of 15 times. So currently we're at about 20, and 15 times is approximately 20 to a 30% correction. Again, it's very company dependent, but it's really worth asking the question, for the companies that we do own, will the earnings be similar or close to its performance in 2021? A very similar situation in Bitcoin. I was expecting the hot CPI print to push the Bitcoin price because at the end of the day, even though it is treated as an inflation hedge, it behaves like a risky asset. So I was expecting Bitcoin to actually go below 20,000 again, but it seemed like it's pretty resilient around 20K at the moment. At the same time, when it comes to crypto prices, you never quite know. So I wouldn't be surprised if it does dip below 20 again. The main question is, how does all of this impact us? For those of us holding assets like stocks that are US based, I think we already know how that story pans out. It's likely going to hurt a little bit more depending on the upcoming earnings season. Prices for goods and services will likely continue to go up until central banks around the world raise rates to destroy the demand so that our supply chain can actually have the breathing room to catch up. Obviously, this is made more complicated than it needs to be given there is a war on the other side of the world, and it's made even more complicated given the situation in Sri Lanka as well. I'll make a separate video on the Sri Lanka situation. And off the back of central banks destroying the demand to control inflation, some of these companies will likely need to downsize or lean down so that they can focus on surviving this period. Companies that don't make money are especially prone to this. Buy now, pay later companies, startups, or Uber, for example, they will likely need to downsize their workforce to reflect this new environment. And if we take an Australian lens, it's very likely that as the US raise rates, and so will us, it's very likely we're going to head into recession. And with every recession, our employment rate have grew by at least 1 full percentage point in each of the last 5 recessions. So I'll be expecting that. When unemployment goes up, price of food and rent is also going up. Recently, Australia have copped a huge rent increase. The things that are not necessary in the consumer's spending habits will likely go. And whatever they give up will likely reflect in the upcoming company earnings report. So one of my main questions for you is that, do you believe that the company earnings will be as good as last year for whatever company that you do own? If not, again, highlighting the point that the price of stocks will do need to come back down to reflect the new reality. So the next question is, what am I personally doing? I have 3 priorities. 1, my ability to earn income. So I've been prioritizing my full-time job recently, just mostly because I've gotten more responsibilities. I needed to invest in my team to make sure that we're in the best position to be successful. And when you can do that and do a really good job security shouldn't really be a question, but I have been prioritizing that part of my life recently. Secondly, I have been focusing on building a cash cushion. Generally, a cash cushion just helps you sleep better at night. I mean, it shouldn't be a special thing that you do only during this period of time anyway, but this is something that I've been focusing on. And off the back of cash cushion, my third priority is focusing on accumulating cash a little bit more, just so that I can go capture opportunities and wait for things to settle back down before I have a lot more confidence to go dollar cost average into my portfolio. My portfolio hasn't really changed, it's still relatively the same, but having some cash, I guess dry powder on the side, it gives me the opportunity and the option to go out and actually buy things on the cheap. And that's something that I'm personally focusing on. The final thing, which is kind of like a bonus that I found, is spending a little bit more time working from home. I realized that spending more time working from home have saved quite a bit of time in transit, quite a bit of money in transit, not to mention eating out, and also just like generally bad habits when you're out and you just find yourself spending money. So that helps me manage my own cash flow. And I would love to know, what are you personally doing to get through this very turbulent time? And until next time, my name is David. Otto will always do the honors, and I'll see you very, very soon.